Hello, I am Cem Yasar Ozey. Welcome to the Weekly Market Notes program. Don't forget to subscribe to our channel and like our videos to stay informed about the latest developments in the markets. Today, we will thoroughly discuss the global and local financial agenda of the past week. We will cover many topics, from the Fed's interest rate policies to US-China tensions, gold record highs to turbulence in the crypto markets, Turkey's economy, and the upcoming week's calendar. If you're ready, let's start. As the week begins, investors' focus is on the Federal Reserve's interest rate decision. The September meeting minutes were released, revealing that most members emphasized economic slowdown and weakening labor markets, calling for further interest rate cuts. Market expectations now price in a 93% chance of a rate cut at the October meeting and a 79% chance at the December meeting. These expectations have strengthened the belief that global liquidity will increase, leading to record levels being tested in the stock markets during the first part of the week. However, signals that the economy is cooling down did not provide a lasting relief. The data immediately following the minutes indicated elements such as weak non-farm payroll growth, declines in PMI indices, and pressure on corporate profit margins, all of which pointed to a recession risk. While markets were pricing in rate cuts, we saw very clearly on Friday how a single negative headline could shift the balance. It is important to keep this fragility in mind, as asset classes with high valuations react sharply to even the slightest shock. The most striking development of the week was President Trump's statements regarding China. As a retaliation for China's rare earth element exports, Trump announced that he would impose a 100% additional customs duty on all imports from China. This announcement reignited concerns about the US-China trade war, which had been thought to be put on hold for some time. More importantly, the tone of the statement was ambiguous. Trump said, "It will take effect on November 1st, but I may back down if China steps back." Such vague statements disrupted investors' risk perception. Trade wars have extended to rare earth elements, which are vital for strategic sectors such as technology and artificial intelligence. China controls a large portion of the global supply in this area, and when it restricted exports in retaliation for sanctions, a strong response came from the United States. The question of, are global supply chains breaking down again, has started to be discussed in the markets. The threat of tariffs could bring supply chain pressures back to the forefront, disrupting company profit margins and inflation expectations. The trade tension was further compounded by the US government shutdown. Due to the budget dispute, the federal government is temporarily closed. This delays the release of critical data such as employment, inflation, and growth figures. For example, there is a possibility that September consumer inflation data will be postponed to October 24th. As markets lack access to economic data, they rely more on forecasts and expectations, increasing volatility. Additionally, millions of federal employees are not receiving paychecks, and some are placed on mandatory leave, which could temporarily weaken consumer spending. The tension in the markets did not reflect on the US dollar index. Expectations of Fed rate cuts kept the dollar weak throughout the week. However, during the panic on Friday, DXY recovered and rose above the 98 level. Some technical analysts are discussing a double bottom formation in DXY and suggest that if the 99.8 resistance is broken, the dollar could enter a new upward trend. The direction of the dollar will be critical, especially for assets like gold that are inversely related to the dollar. Looking quickly at other global agenda items. Ceasefire news in Gaza. The temporary ceasefire announced during the week brought short-term relief to the markets, but was not enough to change the main trend. Government crisis in France. The Prime Minister's resignation caused fluctuations in European markets, but its impact remained regional and had limited effect on global risk perception. These developments show us how quickly geopolitical risks can influence markets, often more than economic data. A political statement, an export restriction, or even a resignation can cause risk premiums to spike suddenly. The sharpest reflection of the tariff shock was seen in the American stock markets. The indices, which tested record levels throughout the week, plummeted on Friday. The 2.7% decline experienced in the S&P 500 on Friday marked the worst day since April. Although the index remains in double-digit gains since the beginning of the year, profit-taking pressures accumulated at record levels were triggered by this external shock. Downward, the critical support levels are 6,500 and 6,400 points. Responses had come from those levels. Upward, a new record seems unlikely without surpassing 6,650 and 6,700 points. The decline on the Nasdaq side was even sharper. The index, heavily weighted with technology stocks, closed the week at around 22,204 points, down 3.6%. Nasdaq, one of the best performing indices of the year, had risen due to high growth stories. However, when economic uncertainty increases, investors quickly exit these stocks. Analysts indicate that if the psychological level of 22,000 points is broken, levels of 21,600 and 21,200 could come into play. Resistance levels are monitored at 22,500, 22,800, and 23,000 above. The valuation of technology companies generally relies on future growth expectations. Falling interest rates increase the value of these firms because the present value of future cash flows rises. However, when economic uncertainty increases, investors lose confidence in these stories and turn to safe havens. Furthermore, because algorithm-based trading and passive funds have a high share in technology stocks, sell orders can create a domino effect. Friday's chart clearly showed how quickly risk can transfer from one asset to another. The other destination for escaping risky assets was US Treasury bonds. Expectations of Fed rate cuts were already driving bond yields lower. Along with tariff shocks and risk aversion, the 10-year Treasury yield fell to 4.14% by the end of the week, and the 2-year yield dropped to 3.59%. Falling bond yields increased the appeal of non-yielding assets, primarily gold. This played a significant role in the record-breaking highs seen in commodity markets. The star of the week was undoubtedly gold. It rose throughout the week, reaching an all-time high of $4,059. This marks the 8th consecutive week of gains and is recorded as one of the longest rallies in gold history. Factors supporting gold prices: expectations of interest rate cuts. The Fed lowering interest rates and the decline in US Treasury yields make non-yielding gold more attractive. Weak dollar. The weakening of the dollar index pushes up the price of gold, which is the opposite of the dollar. Geopolitical uncertainty, US-China tensions, developments in the Middle East, and political crises in Europe are directing investors towards safe haven assets. Central bank demands. In 2021, 10% of total gold demand came from central banks, and today this figure has increased to 24%. Events such as the freezing of Russia's assets are encouraging countries to diversify their reserves. Interest from individual investors. The increase in social media posts about gold and FOMO, the fear of missing out, are attracting small investors to the market. With the rise in gold prices, the gold-silver ratio also declined. Still, it's worth noting from history. During the gold rally triggered by the Iran crisis in the late 1970s, the ounce price peaked in 1980 and then lost more than half of its value within just 2 years. It took 27 years for those who bought at that peak to recover their principal. Therefore, although gold is considered a safe haven when prices become excessively overheated, risk management should not be overlooked. Silver also dazzled along with gold. An ounce of silver rose to $51.22, its highest level since 2011, marking an 8-week increase. Silver, being both a precious and industrial metal, is also influenced by economic activity expectations. It is worth noting that silver is more volatile than gold. Therefore, while gains can be rapid, corrections can also be sharp. The deterioration in global risk appetite showed the highest volatility in the cryptocurrency market. The sell-off that began on Thursday night intensified on Friday, causing declines of 5 to 15% in Bitcoin, Ethereum, and other major altcoins. To understand price movements in the crypto market, 2 mechanisms should be considered. 1. Leverage trading. Investors on crypto exchanges often open positions with borrowed funds using leverage. When prices fall below a certain level quickly, collateral becomes insufficient, and exchanges automatically liquidate these positions. Since liquidations lead to new sales, the price decline accelerates. This is called a liquidation spiral. 2. Market depth. Compared to traditional exchanges, crypto markets have lower trading volumes, so large sell orders cause more pronounced price movements. Additionally, since a significant portion of crypto investors are individuals, panic selling spreads. Bitcoin, after testing the $122,000 level throughout the week, fell by 7% on Friday, dropping below $110,000. Supports are at $110,000 and $105,000. Resistance levels in an upward trend are at $120,000, $121,500, and $124,500. Ethereum, approaching its record with $4,800, declined to $4,370. Support is at $4,270 and resistance at $4,440. Ripple, XRP, after surpassing the 280 level during the week, fell to 245. It closed around $2.10. Supports are at $220 and $2, with resistances at $280 and $3. This decline in the crypto market reminded us how sensitive global risk perception is to crypto assets. The possibility of prices fluctuating by 10 to 15% in a short period highlights the importance of risk management for investors. Despite the global storm, Turkish markets experienced a relatively calm week. There are a few reasons behind this. Borsa Istanbul closed the week flat at around 10,700 points. It was not affected by the global sell-off on Friday. Domestic high inflation keeps real returns attractive, maintaining demand for stocks. Although expectations of tight monetary policy and global risk aversion exert downward pressure, domestic demand balanced these factors, leading to consolidation. On a weekly basis, it remained almost flat with a very slight decrease of less than 0.0%. It fluctuated between 10,654 and 10,928. The near support levels are at 10,650 and 10,600. Below these, 10,250 and 10,000 are support levels. Above, 10,900 and the psychological resistance at 11,000 are the first hurdles. Higher up, the main resistance zones are around 11,300 and 11,600. What I see is that BIST 100 is holding at resistance but struggling to surpass 11,000. Next week, global sentiment and domestic interest rate expectations are likely to determine the direction. That 11,000 resistance is significant. If the global markets calm down and an appropriate step is taken domestically, that could be tried again. If not, support levels will be watched. When looking at the USD TRY side, that side was calm. The resistance is at 42. When gold prices hit a record high, gross reserves increased to $192.9 billion. Already, 53% of the reserves are in gold. Every $100 increase in gold adds significant value to the central bank's balance sheet and is seen as a confidence factor in the markets. Therefore, we can say that the global flight to risk has, in a way, created a protective shield for Turkey. But the detailed picture shows that when excluding swaps and the appreciation of gold, meaning when looking at the bank's net foreign currency position, there has actually been a decline since September 1st. The net position excluding swaps appears to be $51 billion, but most of this comes from gold. Without gold increasing, it would have been lower. Still, over $30 billion is considered reasonable. The interest rates on government bonds denominated in Turkish lira were slightly affected by the deterioration in global risk appetite. The 2-year rate rose to 40% and the 10-year rate reached 32%. Not only is foreign interest weak, but more importantly, domestic investors, especially households, seem to have lost interest in bonds or are even selling them. This could be exerting upward pressure on interest rates. Turkey's 5-year risk premium, CDS, ranged between 258 and 263 basis points, closing around 258. In other words, there is a slight increase in risk perception. This is consistent with the rise in interest rates. According to data from the Banking Regulation and Supervision Agency, individual foreign currency deposits have slightly increased, while companies strengthened their Turkish lira positions by selling foreign currency. Residents increased their gold purchases. This is thought to be due to the rise in gold prices. Foreign investor entries remained limited. This situation causes a low foreign share in TL assets. The increase in CDS spreads is also partly due to this weak foreign inflow. Especially, the exit of domestic investors from bonds could put pressure on interest rates and complicate the central bank's task. Domestic demand will be critical for the trend of interest rates. The central bank's actions will influence this trend. September CPI increased by 33.3% year-on-year and exceeded expectations. The high inflation reinforced expectations that the central bank might slow down or temporarily halt its interest rate cut cycle. The market participants survey revised the year-end inflation forecast upward. This increases the likelihood that the year-end inflation will remain above the central bank's estimated range of 29%. Service inflation remains particularly rigid. After this data, expectations about what the central bank will do have formed. In September, they cut the interest rate to 45%. But with inflation also rising, expectations grew that in the October meeting, the bank might either pause the rate cuts or significantly slow down the pace. This will also be an important test for the bank's credibility. There are some stress indicators on the financial side, such as protested bills, non-performing checks, and an increasing trend in unpaid personal loans. Credit growth has also slowed down. While the share of TL in deposits remains relatively stable, the increase in foreign currency share in funds is an interesting detail. High interest rates make deposit interest attractive, which could encourage staying in TL. However, high interest rates put a burden on the budget. This indicates that the economic management needs to take balanced steps. The external balance is currently one of the strongest points. Tourism revenues are performing very well, supporting the current account balance. It is expected that the current account deficit will remain low. On the financing side, direct foreign investments and portfolio flows through swap channels are positive. The direction of monetary policy in the upcoming period will be very critical. The October meeting will send important signals. We took a detailed look at last week. Now, all eyes will be on what happens in the upcoming week. On the global agenda, the US earnings season is beginning. Financial results from major banks such as JP Morgan, Bank of America, and Citigroup will be announced. These earnings reports will provide important signals about the health of the US economy and the state of credit markets. Strong earnings could revive risk appetite, while weak earnings might deepen risk aversion. US CPI data. Due to the government shutdown, the release may be postponed to October 24th. However, inflation expectations will still be monitored. Since inflation is one of the key indicators for the Fed's interest rate policy, a high inflation reading could weaken expectations for rate cuts. IMF and World Bank meetings. During the annual meetings in Washington, global growth outlook, inflation, and debt levels will be discussed. Debt sustainability of developing countries and central banks' gold reserve strategies may also be topics on the agenda. ABD-China relations. Whether China will respond to Trump's tariff announcement, new restrictions on rare earth elements, or negotiation signals will determine market direction. Geopolitical risks. Developments in the Middle East, political uncertainties in Europe, and Russia-Ukraine tensions could influence pricing. In Turkey's agenda, current account balance. External balance data for August will be announced. Analysts expect a surplus of approximately $5 billion. A current account surplus may be perceived positively for the lira. However, gold imports and energy prices could influence the current account balance. Budget balance. The Ministry of Treasury and Finance will announce September budget realizations. Developments in the budget deficit will provide clues about fiscal discipline. Central bank market participants survey expectations of economists and the financial sector regarding future inflation, exchange rates, and interest rates will be monitored. This survey reflects market expectations for monetary policy. S&P Credit Rating Assessment. The International Rating Agency. S&P's statement on Turkey's credit rating and outlook on Friday is significant from the perspective of foreign investors. Any revision to the rating or outlook could impact the markets. Local economic data, indicators such as the Industrial Production Index, housing sales data, and tourism revenues will signal the course of economic activity. Other points that should not be overlooked include credit conditions. Tightening of bank lending standards in the US and Europe poses a risk to global growth. The earnings season will provide more information about banks' credit portfolio quality. Corporate profit margins. Rising wages and input costs may pressure company profit margins. This could lead to fluctuations in the stock markets. Liquidity conditions. The Fed and the European Central Bank's balance sheet reduction steps will be monitored. The tightening of liquidity could increase volatility, especially in the cryptocurrency market. The main message to take away from this week's summary is how fragile the markets are. While expectations of Fed interest rate cuts and abundant liquidity are pushing markets higher, a single political statement or trade move can wipe out all this optimism. The divergence between risky assets and safe havens has become more pronounced. Gold and silver are hitting record highs, while stocks and cryptocurrencies have experienced sharp corrections. For Turkey, the global risk aversion has been mitigated by the central bank's high gold reserves, providing a protective shield. The Istanbul Stock Exchange remaining flat and the stable exchange rate are positive signs. However, high inflation, interest rate policies, and rising CDS premiums pose challenges for economic management. The continued cautious stance of foreign investors is also a factor to watch. Next week's company earnings reports, current account balance, and S&P analysis, along with tariff tensions and geopolitical risks, will shape market directions. The key question is, will strong corporate profits be enough to suppress the rekindled fears of a trade war? We will find out in the coming days. As we conclude this broadcast, I wish all viewers a profitable week. You can share your questions and comments below. Don't forget to subscribe to our channel and like the video. Until we meet again next week to evaluate new developments, stay well.